Hey everyone, this is Nick Saylor of Saylor Business Solutions and the VMG Real Estate Tax Group. This is video number 2 in a series on the short-term rental tax strategy. In this video, I'm going to be explaining the history of real estate being used for tax strategy and how depreciation works. So let's talk about real estate and depreciation. What is depreciation? In my last video, I explained how deductions worked and business expenses work to lower taxable income. Depreciation is a type of expense or deduction for a business or for real estate specifically. Depreciation can happen with business vehicles, it can happen with buildings, it can happen with computers. Depreciation is basically what we do on paper on our taxes to reflect real property or personal property losing value over time. So if I buy a computer for my business, a nice computer, and it's $5,000 and I want to depreciate it, generally you would depreciate that over 5 years, so you would get a $1,000 depreciation expense per year that would lower your taxable income. Now, on a big scale with a real estate property, you can understand that if you bought a house, it's not going to exist forever. It will probably deteriorate over time. You'll need repairs, things like that. So what depreciation is the IRS and taxes' best effort to represent the decline in value of property over time. So if you bought a house for $500,000, first what you would do is divide out what the land value is and what the building value is. Reason for that, land doesn't go away, it doesn't depreciate. So we would basically allocate what percent of that $500,000 purchase price went toward the building, and that's its depreciable basis. So if the land was worth $50,000, you would get $450,000 in building value that would be depreciated over time. So what does this mean for you and real estate investors? So for investors today, we would generally depreciate a building over either 27.5 or 39 years, depending on what the building is used for. Now, the short-term rental tax strategy allows you to take that depreciation a lot faster, and we will get into that in future videos. But first, I'll tell you about what it was like before 1986. Here's an example of something that would happen before 1986 that high earners used to save a ton in taxes. So you could take depreciation a lot quicker on rental properties, and it could also count against your active income. So let's paint an example of a doctor before 1986. For simple purposes, we'll say he made $500,000. He could buy rental properties, depreciate them faster because they would have things like 15-year life on buildings instead of 39, and there was accelerated depreciation where it would go quicker. So they might get a property, this doctor might buy a property that in economic reality is cash flowing. They might pay $20,000 of payments on it and get $24,000 in rent, they'd make $4,000. But if it was a building that was a few $1,000,000 and they could accelerate depreciation and pull all these levers, they might get something like a $100,000 deduction or $200,000 deduction. And I'm making this up, the numbers might not all scale together. But when they got that deduction through depreciation, depreciation isn't money that they have to pay, it's just a paper loss. It's representing that the building is losing value, so the IRS is going to give you some expense against your income to account for that. But what happened was, and why this was so great for high earners, was because they got to take these losses that depreciation created and count it against their active income. So if the doctor made $500,000 but they had a $200,000 deduction created by depreciation on a rental property that was already cash flowing, but they were just accelerating depreciation, they would massively reduce the amount of taxes they would pay. And this could scale up to where people wouldn't pay any tax at all because they were just buying real estate. So when you hear about the wealthy using real estate to reduce taxes, they still do it, and I'll show you one way how. But before 1986 was the heyday. They were all doing it. So they were basically accelerating depreciation and counting it against their active income because the door wasn't shut on that. In 1986, passive activity rules became a thing where they standardized the life of depreciation. They made it straight line, so you take 1/39th every year if it's a 39-year depreciation instead of accelerating it, and things like that. Depreciation is a non-economic expense, I guess you might say, that can create paper losses on your taxes. For most people today, if they have a rental loss and they make over $150,000, they have to carry forward that loss into future years so that it can offset rental income, rental gains, because there's passive income, like rental income, and there's active income, which is like W-2 income, business income. So that's what's changed, and that's the history of it. But now you understand how depreciation works and how it was used in the past, and you can kind of think about it, because the short-term rental strategy, and I will explain it in the future videos better, the short-term rental strategy kind of brings back some things that existed pre-1986, where we can accelerate depreciation and change the life on some of the pieces of the building. Because generally, a building depreciates over a long time. So if we can bring it forward like, was done pre-1986, that's good. And also with the short-term rental strategy, if you do things right, and you got to have logs and time it all right, we'll get into that, you can count it against your active income too. So a high-earning doctor could still do something like I just explained with the short-term rental tax strategy and save a ton in taxes. Super briefly, I am just going to show you a scenario here of like this old school, if we could do this sort of thing. So in a base case, if you earn $400,000 in wages, and this is a similar example to what I used in the previous video, you would owe about $109,000 in taxes, $21,000 in state taxes if you were in Georgia. Now, you would have some withholdings that would have already covered some of this, but that is the amount of tax you would pay if you were a single person. Now, if we were able to just really easily, like the pre-1986 accelerated depreciation, like I just explained, if we look at that and we were able to get a $200,000 rental loss, we would only pay $39,000 in federal taxes and less than $10,000 in state taxes. So this models out the difference, $70,000 less, which, if you're not actually paying that $200,000 expense, because it's not a real expense, it's just a paper expense, can be pretty incredible, because then you can take these tax savings and invest them into getting more real estate for the next year. So we can do stuff like that with the short-term rental strategy. I'll explain it, but just in general, this is awesome to understand how it works and how the tax game is played and has been played in the past. That's all for this video. Make sure you watch the next one, and we will keep going on the short-term rental tax strategy series. Thanks.